All right, so we're going to talk a little bit about the stock market. Well, we're more focused on stock market data, but that's where our focus is today. I'm going to go over a few things that I actually have in the book here just to read them through. You can find this information on this line as well. Just a few terms. So the stock market, again, is just a group of companies. Really, it's an institution which people buy and sell shares or parts or pieces of companies. It's varying all the time. Some companies live and die by this. That's all they do is buy and sell. They have whole server rooms dedicated to lightning fast transactions that are occurring to make even thin margins some margin of profit. The two main ones that we know about are the NYSE, or the New York Stock Exchange, and the NASDAQ, which is the National Association of Securities Dealers Automated Quotation System. Let's just call it NASDAQ, okay? You don't have to be a professional investor to work in this arena. In fact, you'll be surprised a majority of investors try to beat the market, end up losing or doing worse than the market. And so it turns out they could have just bought shares of the NASDAQ, or anything else. It could be the S&P 500, an index fund, and have done just as well or better. So it's kind of a scary thing. The biggest trend, I think, if you want to look at this, and I'm going to get this set up here right, is this. We're going to go ahead and draw the stock market. This is just a representation. Right? If we're looking at this as time, and this could be value, and let's say this is the S&P 500, just as an example, an index fund. What is the overall trend that's happening here? Even at our low right here, horrible, horrible, horrible. But if you bought here, that's a positive increase. You just had to wait a long time to get to it. If you bought here, that's a scary drop. That is huge. That is a huge loss, right? But then in a very, I'd say, short time, depends on how our scale is, it could be a longer time, you're above where you were, right? The overall trend for the stock market is positive. And short of a zombie apocalypse or something like that, the overall trend for the stock market is going to go up. The biggest thing we have, the biggest asset we have in our possession is time. Younger people have more of this, which means they can be more resilient when the stock market does something like this, because the upside is still going to be better. If they're starting in right here, this is still change. You just have to weather this storm. So I'm going to talk a little bit about gambling, because really that's what this is in a nutshell, depending on how you're doing it. Buying shares in companies that you believe in isn't necessarily gambling. If you feel those companies are going to do well, that's fine. The problem is people put in more than they should. They overextend their money. They say, I have $10,000, but 5,000 of that is my rainy day fund. And I'm going to lop this whole thing in right here. I go in for major surgery right here as the market is tanking. Let's use some other color here. Well, the market is tanking. I go in for surgery, and I need that rainy day fund. And the market keeps tanking. Uh-oh, I'm in trouble. So the stock market is a very scary thing. Again, I mentioned it was originally coming from a ship, a crew of people that would go and travel the world and find different goods and different commodities and different things, and they would come back and you would get a portion of that. That's still risk, because we're still in a scenario where our ship could capsize and everything's lost at sea, and the person sitting on land with a piece of paper that says they have ownership in this piece of this ship sitting in the bottom of the ocean, that paper is useless. And that happens. Companies live and die all the time, and you have to make sure you are thinking about that. My recommendation is go with an index fund. Overall, the trend is positive. It reduces some of the upside, but it also reduces some of the downside, and you get more of a steady climb. And again, if you're young, like all of you in my financial algebra class are, that's a great thing to do. Start now, use time because you have it. A few terms that we're going to talk about. Let's go ahead and get a new page up here. A few terms we want to talk about is actually, you know what? I've got a better idea. I have an image here that we can use for reference. So we're going to use XYZ Corporation as an example. We have a few terms here. We have last. And what this means is we're looking at a ticker or information at the end of a company's day trade. At the end of the day, there's going to be some information populated. Last is the price per share of the last trade that was made for a particular stock. So in a static company like a newspaper print or a paper ad or something like that, it's usually going to be the closing price. Now online you have more accurate information in more real time. It's going to be closer to a specific trade because what we see in the newspaper might not be reflecting that last minute stuff that happened at the cutoff. That closing time typically is 4 p.m. Eastern time for most stock markets in our country. That's usually about 9:30 to 2 p.m. Eastern time. So if you're sitting on the West Coast, obviously you're going to get up a lot earlier, but you'll be done earlier too, right? The closing price is that last price at which the stock was traded during that regular trading session in there. There's a high and a low piece. So we have high and we have low. That just means that throughout the day, we talked about long-term stocks. We mentioned that you have things happening throughout the day. Let's just say this is May 4th and May 5th. That just means that it started at some value and it varied and fluctuated throughout the day. We're hoping it ends on a high note. We don't know if it will. But the lowest point would be anywhere on that graph that yielded the lowest possible value. In this example, we're saying our lowest value is 49 even. And our highest point, wherever that is, in this case, it happened to be at the close. Technically speaking, I think our close, it would be here. This would be our close here. Because according to our data, our close value is 52.20 and our 52.60 is our highest value. So 50, let's just draw a line to it. It was that our highest value was 52.60 and then our close value was 52.20. The high and the low, we want something where we can buy this and time this just right. Now, to give you an idea, let's say you're going to buy 100 shares of stock. In here we're saying sales in hundreds. They refer to this commonly as packets of 100. Like if you're playing Monopoly and you have a bunch of 5,000, play money dollar bills. If you have 10 of those, a stack of 10, you would have 50,000. A stack of 100, you would have 500,000. So when it comes to sales in hundreds, all we take is the sales there and multiply by 100. So in this example, 2.8 million. So I'm going to say we're buying 100 shares, so 100. And we're going to say that we were just perfect. We timed it to buy at the low. So we started the day at 50.10 and then we dropped down. We dropped down just a little bit, not a whole lot, about $1.10 I guess. But we bought it at 49. We say we're going to buy 100 shares. So we spent $4,900 of our money. In fact, you know what? Let's use some color in this. Why not? Negative 4,900. And the way that trading works, you buy or sell. If you buy something or sell something, you're paying a fee on that transaction. So if you buy 1 share or 1,000 shares, typically the fee is the same. So we're going to say it's $10. You can find that out there. So our total cost, the total risk that we're taking on is this, because what if something happens and that company just dies? It's gone, right? So if we're buying at a specific company, that could be scary. But we bought in. We were fortunate that we were able to we were able to sell on perfectly the high. We just happened to time it just before it closed, and it went down to that 50, or sorry, before it went down to our 52.20, we sold at 52.60. So we're going to add in plus 52.60, but that transaction, because we sold at the high, is another minus 10. So really what we have is 52.50. Now, anybody looking at this should be able to see that we made a profit. The question is, was it worth the risk? Well, that's a question that everybody has to make for themselves, because the reality is we all have different risk preferences. We all have different things that we think are important or not important. And so there's really no one that can tell you, well, what's worthwhile. If you're a low risk person, maybe taking this value here, maybe taking this value here and saying that's what I made, $330, wasn't worth the risk. Because I had to buy 100 shares of this. I had to spend almost $5,000 to make $330. Now we can go and figure out how much we earned, right? I mean, if we think about the percentage increase and all that, we could determine what rate we're actually getting as an investment and decide, could I have made more elsewhere? Again, that's going to be for you to really ultimately decide on your own when we do this math. One of the ways that we can determine how this is doing is by looking at the number of shares that are being traded in a given period of time. We call this volume. Again, that's in sales of 100, so we would reference that as the 28,000 100s, or 2.8 million. We can also look at things like the 52-week high. We can say in the course of a year, our highs have been about 60, which is great, but I think really as a risk concern or something to think about is that low, 43.60. As a 52-week low, our average low value, or the lowest value I should say, not average, was 43.60. Is this spread something we're comfortable with? We're looking at about 17 bucks as a spread. And again, if we are not being this buy and sell in the same day area, and remembering that the stock market has a general upward trend, and we're not investing in $5,000 that goes to pay rent or emergency medical expenses or our kids' college fund or whatever that we have in the immediate future. If we're able to put money in that we don't need and we can forget about for 10, 20, 30 years, then this is a safe bet. Then you're looking at other things like, is the company in a high risk area? Is it something that is it a domestic business? Is it an international business? Is it something where there's a lot of barriers to entry so they can remain, growing and growing and growing, or are they going to get hit by when someone else comes in and does the product at a cheaper rate? Right. So those are some things that we need to consider. Now, when we talk about information, we don't have anything for yesterday, except we do know that we opened at $50.10. We're saying, first of all, that today's close, we closed at $2.61 from yesterday's close. So that means yesterday we were sitting at that 49 and something cents. So actually we can do that math. Let's go ahead and do that now. If yesterday, or today I should say, we opened here and then closed here, and we changed from today's close. So today's close was $2.61 to the positive. That means we're going to take our setup here. You know what, let's change that a little bit. There we go. That'll work better for me. And perfect. So we have this setup here, and we know that today, we can say today's close was 52.20. So we'll say 52.20. There we go. And we're saying that yesterday we were sitting at 49.59. So May 4th to May 5th was a positive increase. But we're saying in our original graph, we're saying that we're sitting at $50.10. That's because there's a thing that we like to call after hours trading. It just means that sometimes when we close one day and open the next day, there are some trades that occurred after hours. The market is still in flux, it's changing all the time. And so those are things that we need to consider. But that means this right here is positive. We have a couple other things we want to look at. Our highs and our lows. Our 52-week high, we said our 52-week high was 60.45, and our low was 43 and 60 cents. So our stock can do anything in here based on that. Now, obviously, it can breach this. It can breach this. It can come lower. And it can go higher than that. We're not saying it can't. We're just saying that on average, or if we look at the whole year, the lowest it's ever been is this. And so then it's up to us to say, well, 2 days isn't the best information. Again, if you are young or older, more time is better. Okay, I wrote that in weird flipped order. More time is better. The more time we have, the more this gives us a better view of what's going on. We can take a line of best fit or a regression line to look at all these different data points and figure out what is the trend for this. Are we positive, negative, or neutral? And we can make that decision on our own. A couple other things we want to talk about, though, going forward are our percentage increase or decrease. Because really, what we want to know is a rate. You know, it's hard to just look at something compared to another company and say, hey, you know, Apple, their stock value went up by $80. That's huge. If I'm comparing Apple to, let's say, I don't know, it could be a Target brand, it could be a box of Q-tips, and you could say, hey, their stock went up 13 cents. You know, that's not super amazing, but if their stock value wasn't that big in the begin with, from one day to the next, if it's not a very big stock, then we can start looking at weights of everything and say, what is the percentage of this company? Now, obviously, Apple is likely going to have a larger impact financially if you're owning a stock in Apple versus you are in a box of Q-tips at Target, but that's not really relevant here. What we're going to look at is our open and our close values and over the close value. Now again, so we're using the May 4th example. We said that we were closing at $49.59. That's that $2.61 increase that we had from today's close, the May 5th, to yesterday's. And we said today we opened at $50.10. We're going to take the difference of those, and then we're going to average that out over this close right here. If you calculate that out and then multiply that by 100 to get a percentage, that yields a percentage, I get about 103. So we talk about percentage 1.03, approximately a 1.03 increase in price per share due to after hours trading. That's all we're saying here. That in this example, we're using after hours, and you can use anything. You can say, what's the percentage increase from yesterday's close to today's open? That's what we've done here. You can say yesterday's close to today's close, and we could calculate that in. That wouldn't be too hard to do. We just say today's close was 52.20 and substitute that in for this value and find the percentage increase and figure that out. When we talk about this value, that's positive. We like that. But it's not always going to be positive. Let's see here. There we go. Sometimes the market doesn't do what we want it to do, and we deal with what we call the percentage decrease. Now this is great if you're looking to buy something. If you're watching a stock and you don't own it currently, that's great. So let's say on May 6th, XYZ Corporation announced a decrease in earnings. Because of that, because that's how the market works, the price of the stock dropped. It closed at 44.37. We want to know the net change from the 5th to 6th as a percent, so we're going to take the May 6th close, which was the 44.37, and we said that our closing on the 5th was 52.20. And again, we're taking that value out of the close value. That's what we're looking at. If you think about it, we have A minus B over B. These will be the shared term in both of these. And when I calculate that, I get a drop in 15%. Much bigger change. The net expressed amount is negative 15%. That just means that we've closed quite a bit considering we were sitting at 52.20. Now again, we need to understand something very important. My big takeaway for the life lesson here is this. First of all, don't buy individual stocks unless you have passion in that business. You just don't know what's going to happen. But if you are going to buy them, understand buy and hold mentality. The stock market is ups and downs all over the place. Right now, there's lots of stuff going down because of COVID, right? But on average, we are looking at a positive growth. Value, time. The more time we add in here, the better. Those of you who had my financial A class, we talked about the stock market and said, give me, graph it and look at it. And we can see things like the Great Depression or recessions or COVID or any kind of financial disasters. 2008 was a horrible time, right, for a lot of value. Homes were cheap. People were leaving their keys on their kitchen sinks and walking out of their house. It was better to walk away than to sit and own that place any longer, right? The stock market overall, though, is positive. Short of a zombie apocalypse or some Armageddon type style end of the world, which case your stock won't matter anyways. Money won't matter anyways, right? It'll be what your skill level is at that point. But barring any science fiction or futuristic apocalyptic storyline that we see in the movies and in books and stuff, the stock market is positive. It's going up. You just have to have the patience. Don't invest what you aren't willing to put away for a long time. Invest if you get money that you didn't expect to have, like, I don't know, tax returns. If you rely on this as an income, then maybe you need to reevaluate what you're doing there. If you look at that as just money to put into an account and sit that money over time, it's going to start building in value over time, because that's how growth works. It's exponential. If you've learned anything about exponential growth with COVID-19, you understand that the more we have and the more it all starts to add up and compound and build. This is exponential. But it requires patience. It requires market timing. There's a lot of other factors in tax and everything, but overall the biggest thing that you need to worry about, and the takeaway I have for you in this chapter, is understanding the market conditions. Understand that there's going to be costs, right, associated with making transactions, but those costs can be dealt with. Usually they're a fixed amount, and if you have the capital to do it, great, time it. Maybe look at index funds or something to that effect instead. There we go. Instead of trying to beat the market with a stock, instead of trying to bet on a winning stock, just like betting on a winning racehorse or a winning company, maybe try bulk buying and say, I'm going to buy a bunch of everything. Make those ups not so high, but make those lows also not so high, and get a more positive and a more comfortable ride. The more risk, the greater the highs, the greater the falls. Less risk, lower the highs, but lower the falls. It just depends on where you want to be. you're younger, you can bounce back from those big choices. When you're older, maybe not so much. So anyways, with that, that is my take on the stock market. Again, it's really super, I'd say bird's eye view. We're looking at a very, very basic information of the stock market. It's not that complex. It really isn't. There's a lot of ways you can make it complex. My words of advice, if someone comes at you to make something really, really complex look easy, they've probably overcomplicated that thing in the first place. The only reason that a stockbroker exists because it's a complicated mess. Just think about what you're buying. Be smart with it. Be patient. Patience is a virtue, and it really does win out in the end. And best of luck with the assignment. If you have questions, please email me. Let me know, and we'll get started on all that stuff going forward. Best of luck.